Picture this. The clock strikes midnight in Washington, D.C., and the marble halls of the Treasury Department glow under dim lamps. A hush falls as President Nixon's hand hovers over a pen that will sever the last thread tying the US dollar to gold. Imagine startled senators peering through the doors murmuring, "Did he just say no more gold payments?" It's like watching a bank vault door slam shut on the world's most precious metal. 007 would be jealous. In the next 30 seconds, you'll see stacks of yellow bricks vanish into thin air, invisible to the public eye, but not to the titans of finance plotting in smoky backrooms. Senior Fed governors exchange furtive smiles. Hedge arbitrage whispers orbiting like satellites. You might wonder, why did they betray centuries of trust? Well, buckle up, because we're diving into a secret power struggle between the Treasury and the Federal Reserve, where offshore trusts and emergency credit lines play hide and seek. Hold on to your coffee mugs, because this shock isn't some fiction. It's June 1971, and one bold stroke reshapes global markets forever. By the end of this story, you'll understand why the dollar's gold suspension sent ripples through every major economy, and why a handful of insiders cheered as the vaults closed. Ready to uncover the game behind the shock? Let's go. Now let's rewind to the late 1960s and unravel the complex tapestry of institutions, personalities, and global pressures that brought the world to the brink of a monetary cliff. At the center of this drama sat two powerful pillars: the U.S. Treasury, led by Secretary John Connally, and the Federal Reserve, steered by Chairman Arthur Burns. Behind the scenes loomed the International Monetary Fund, trying to hold the gold-backed Bretton Woods system together with nothing more than diplomatic duct tape. Meanwhile, France's President Charles de Gaulle, chanting "Americans, give us back our gold," stoked the flames of dissent in Parisian cafes and fed a feeding frenzy for gold withdrawals. The story begins in 1944 at Bretton Woods, when 44 allied nations agreed to peg their currencies to the US dollar, and the dollar to gold at $35 per ounce. It sounded as stable as a Swiss watch, until US war spending for Vietnam and Great Society programs caused federal deficits to balloon. Gold reserves drained like water through a sieve as foreign central banks engaged in hedge arbitrage, borrowing dollars at low interest and redeeming them for gold at a fixed rate. A simple way to say, buy cheap, sell at a guaranteed profit. By the mid-60s, bankers in Zurich and London whispered of offshore trusts, accounts parked in safe havens beyond US jurisdiction that masked the movement of billions in paper promises. It was as if gold had sprouted legs and gone on holiday, leaving Treasury officials to chase empty vaults. Even seasoned Wall Street tycoons like David Rockefeller found themselves nervously surveying their gold bar collections, wondering whether an invisible hand would swipe them under cover of darkness. Gold market traders in Frankfurt even coined the term gold run, which sounds less like finance and more like an Olympic sprint for bullion bars. Within the Federal Reserve, debates raged like carnival barkers arguing over the last carnival ticket. Burns preferred raising interest rates to curb inflation and stem capital flight. Think of it as tightening the garden hose to slow the flood. While Connally and his team demanded direct controls on gold transfers and import surcharges. "Why not slap on a heavy tariff and call it a day?" they joked, but every diplomatic action risked igniting a full-blown currency war. As the US balance of payments deteriorated, speculation mounted that America could simply run out of gold. Rhetorical question time. What do you do when your vault is half empty and your creditors line up at the door? The Treasury drafted contingency plans, codenamed Project X, to create emergency credit facilities, effectively turning the dollar into an imperial credit instrument backed by nothing more than faith in Uncle Sam. It was a high-stakes poker game, and everyone at the table knew the ante would soon skyrocket. The stakes could not have been higher for everyone from small-town bank managers to global power brokers. All the while, congressional investigators sifted through internal memoranda, documents thick as phone books, seeking clues to why gold flows were unraveling faster than new currency notes. They found memos warning of clandestine loans to South Vietnam to finance military operations, and subtle hints that Swiss banks were offering covert services to funnel dollars overseas. Every institution had a piece of the puzzle, every personality a hidden agenda, and every metaphorical gold brick represented a potential crisis. Now that the players in the stage are set, we can dive into the first clues of this suspenseful saga. Now that we've met the players and set the stage, it's time to follow the breadcrumb trail of clues that kept everyone, bankers, politicians, and intelligence operatives, on edge. Think of it as a three-act thriller, with each act unveiling a deeper layer of intrigue. Ready for the ride? Let's start. First clue, the mysterious account. In early 1970, an obscure Treasury memo referenced an account labeled Account 71G. No one outside a select inner circle knew its purpose. Yet wire transfers for tens of millions of dollars flowed in and out as if by magic. Hedge funds in Manhattan and Geneva began whispering, "Did someone open a secret vault?" Senior Treasury analysts cracked jokes about it being a pay-as-you-go piggy bank, lighthearted until they realized the scale. It turned out that Account 71G was a contingency fund set up to finance covert operations in the Cold War theater. In plain English, that means Uncle Sam was shifting gold-equivalent dollar credits around like poker chips at a high-stakes table. But why keep it off the books? Well, imagine a chef hiding the secret ingredient so no one copies the recipe, and you'll see why Connolly's team insisted on complete deniability. Every incoming SWIFT message was like a drumbeat of suspense, and every outgoing transfer raised the question, where was the gold backing it? Transition. Just when analysts thought they'd pinpointed the source, a second clue emerged, and this one came with an international passport stamp. Second clue, the international informant. By mid-1970, a whistleblower inside a Parisian bank began sending encrypted letters to the U.S. Senate Banking Committee. This informant X detailed meetings between French central bankers and U.S. Treasury officials, where they discussed temporary revaluations of gold stock. In other words, France wanted to jack up the price of gold to put pressure on the dollar peg. Think of it like cranking the thermostat until the house collapses. Informant X described a late-night rendezvous at a discreet villa on the Riviera, complete with cigars, brandy, and a PowerPoint presentation on how to engineer a gold squeeze. Here's your professional term. A gold squeeze is when you restrict gold supply to drive prices up, then cash in on the rally. But the exposé also revealed a side of the story rarely told: how Swiss private banks offered to facilitate parallel settlements in francs, effectively dodging U.S. oversight. Suddenly, the entire gold pool mechanism looked like a leaking bucket patched with duct tape. The informant's letters landed on Senator William Proxmire's desk, setting off congressional subpoenas that read more like spy novels than budget hearings. The suspense. Would France force the U.S. hand, or would the Treasury deploy its secret credit line first? Transition. As investigators chased phantom bank accounts and Riviera villas, a third clue surfaced. This one more alarming than the rest. Third clue, the sudden disappearance of funds. In November 1970, the U.S. gold reserves in Fort Knox and the West Point Depository showed a sudden $2 billion drop overnight. Banking regulators initially blamed it on logistical transfers, but independent auditors smelled a rat. A phone call transcript obtained by investigative reporters captured a Treasury aide quipping, "We just play musical chairs with the gold. No one notices until the music stops." Literal musical chairs? More like financial ones. Meanwhile, London bullion traders reported unusual short positions against the dollar, bets that Washington couldn't cover redemption demands. That's hedge arbitrage at work. You borrow dollars, sell gold futures, expecting to buy back cheaper later, pocketing the difference. But with the U.S. gold stock dwindling, these trades turned into ticking time bombs. Market makers whispered the palabra magica, endgame, with every tick of the ticker showing gold creeping above $40 per ounce in free markets. Suspense hit fever pitch. Was the Treasury moving physical gold to back-channel allies? Were federal agents intercepting shipments before they left New York? And most critically, did Nixon know his pen stroke would lock up all redemption requests once and for all? Through these three clues, a phantom account juggling billions, a Riviera informant spilling secrets, and a sudden vault drain, the narrative built a crescendo of tension. Every new revelation felt like a plot twist in a Hollywood epic. Stakes rose, loyalties shifted, and the line between legality and espionage blurred. If you thought finance was dry, picture trench coats and briefcases stuffed with yellow bricks, all under the watchful eyes of both capitalists and commissars. Now that we've followed the trail, it's time to confront the big reveal. How did Nixon's signature finally snatch the gold anchor from the dollar, and what it meant for the world? Now we arrive at the heart of the story, where smoke-filled back rooms give way to glaring Oval Office lights and the final pieces click into place. In early August 1971, President Nixon convened a midnight meeting with Secretary Connally, Fed Chairman Burns, and top Treasury aides. Transcripts later declassified reveal Connally leaning forward, whispering, "We can't let red lines on a balance sheet stop our war machine." At that moment, the plan crystallized. Suspend gold convertibility, unleash unlimited dollar credit, and keep Cold War spending humming. The breakthrough evidence comes from a set of internal memoranda, labeled Operation Golden Shield, found in National Archives Box 71. One memo reads, "Authorize immediate draw on Federal Reserve swap lines totaling $5 billion for NATO defense aid." Swap lines, in simple terms, are arrangements where the Fed exchanges dollars for foreign currencies with other central banks, then reverses the deal later. Think of it as borrowing your neighbor's lawnmower with a promise to return it plus a beer. By tapping these facilities, the U.S. Treasury could effectively issue imperial credit without draining gold reserves at Fort Knox. Meanwhile, a handwritten note by Chairman Burns instructs New York Fed officials to extend bridge loans to allied nations, short-term dollar injections to keep their treasuries solvent. A bridge loan, for those scratching their heads, is like a cash advance on a credit card. You get money now, promise to pay later. This maneuver, combined with a newly created Special Operations Monetary Account, SOMA, allowed clandestine funding of intelligence operations in Vietnam and Europe, all under the radar of public scrutiny. Contrast this with the public announcement. On August 15th, Nixon took the stage, declaring the temporary suspension of dollar-to-gold exchanges. He called it a necessary move to protect American jobs and curb inflation, yet privately his advisors rejoiced at avoiding a gold run. Rhetorical question, when your vault is half empty, do you admit defeat or change the rules of the game entirely? They chose the latter, effectively rewriting the Bretton Woods playbook overnight. Digging deeper, congressional investigators uncovered evidence that gold bars never left Fort Knox. Instead, the Treasury's accounting entries transferred gold certificates between internal ledgers. A gold certificate is simply a paper claim on physical gold stored somewhere else, like owning a ticket stub instead of the movie poster you paid for. By shuffling these certificates, officials preserved the illusion of backing, even as dollar liabilities ballooned by over $9 billion in a single week. Adding a twist worthy of a spy novel, IRS whistleblowers later revealed that Swiss private banks collaborated in parallel settlements, a euphemism for secret deals evading U.S. auditing. These banks accepted U.S. dollars, handed over Swiss francs, and tucked away the dollars in offshore trusts labeled Project X Reserve. Offshore trusts are legal entities in jurisdictions with lax disclosure rules, so it's essentially hiding your gold bars under a digital mattress. This loophole let policymakers funnel funds to covert programs without triggering public alarms. The immediate fallout was dramatic. Gold's free market price shot above $40 per ounce within days, foreshadowing its eventual surge past $200 in the late 70s. Currency markets, once placid under fixed exchange rates, roared to life as the dollar began to float. Currencies adopted supply and demand valuation, turning each trading session into a new suspense thriller. Investors who understood the Triffin dilemma, the conflict between a national currency serving global reserve needs and domestic economic policy, saw the writing on the wall. They scrambled to hedge against inflation with commodities, real estate, and yes, more gold. And so, with one bold pen stroke and a handful of classified memos, Nixon and his inner circle ignited a seismic shift in global finance. What began as a temporary fix morphed into a permanent repudiation of the gold standard, ushering in an era of floating currencies, colossal debt expansion, and the modern credit-driven economy we know today. It was a revelation filled with contradictions. Professional yet cloak and dagger, legal on paper but eyebrow-raising in practice. As we close this chapter of Revelation, ask yourself, who really won when gold and the dollar went their separate ways? And who paid the price once the dust settled? We'll unpack those consequences and lessons in our final module. As we approach the finale, let's distill the lessons this crisis holds for modern investors and everyday audiences. What began as a temporary suspension of dollar-to-gold convertibility has mutated into a permanent hallmark of contemporary finance. An economy fueled by faith, credit, and the balance sheet wizardry of central banks. Nixon's midnight pen stroke didn't just sever gold's last tie. It unleashed an era where printing presses hum louder than minting machines, and where federal deficits balloon like soufflés in a hot oven. For today's investors, that means recognizing that currency value now hinges more on collective confidence than on tangible reserves. It's almost like trusting a weather app for tomorrow's forecast. Useful, but don't be surprised when it changes by morning. The deeper takeaway is twofold. First, the intertwining of monetary policy and geopolitical strategy never truly ends. It merely shifts forms. From emergency credit lines to quantitative easing, governments continue to leverage imperial credit under new guises. Second, transparency remains the ultimate check on power. Without curious analysts, whistleblowers, and a free press, crucial decisions risk slipping into classified archives, out of sight if not out of mind. So ask yourself, when a central bank announces another round of asset purchases, are you seeing genuine stability or the latest twist in a suspense thriller scripted behind closed doors? For modern finance enthusiasts and casual savers alike, consider this warning. Always question the bedrock of monetary faith. Can any paper promise truly replace metallic certainty? History suggests that while the gold standard had its flaws, its suspension ushered in runaway debt cycles and asset bubbles that still ripple through markets today. Yet there's hope. By learning from the past, investors can hedge wisely, diversifying portfolios, scrutinizing central bank announcements, and staying nimble when policies pivot. In the final 25 seconds, here's what you can do. If this deep dive into Nixon's gold shock left you hungry for more financial history suspense, smash that subscribe button, give us a thumbs up, and share with fellow curious minds. Drop a comment below sharing which hidden power struggle you'd like us to uncover next. Perhaps the secret story behind the euro's birth or the untold drama of the petrodollar. Your engagement fuels our next investigation. Thanks for watching, and until next time, stay skeptical, stay informed, and remember, in finance, the best safety net is knowledge.